And here's another application of time value of money principles, and this one pertains to loan amortization. What is loan amortization? When you borrow money, you have two obligations: to pay off the principal as well as to pay off the interest on the loan. Now, if you noticed, if you paid attention to loans around you, maybe people or you yourself have loans like a mortgage loan or any other kind of loan that requires monthly payments, for example, they're usually the same amount. It's equal sums, monthly sums that you have to pay. What you may or may not know is that every one of these payments that you're making every month back to the lender comprises of two components. Those two components, a part of that sum goes towards paying off your principal, in obviously in partial payment towards the principal, and the remaining is the interest that the loan has generated over that period. So there are two components: you're paying off part of the principal, and also you're paying off the interest that's being generated on the loan. And it's done in a way so that your monthly payments stay the same, but different portions of it go towards each of these compartments over time: the principal repayment and the interest. Now, how does the nature of the payments in terms of the two compartments, the interest payment and the principal repayment, work as over the lifetime of the loan? So at the beginning of the loan cycle, most of the payments that you're making is really going on to service the interest generated on the loan. Very little of it goes towards principal repayment. Towards the end of the loan cycle, the whole thing flips on itself so that most of the payments that you're making is going towards principal repayment and relatively little going towards interest servicing or interest payment. Now, there are interesting consequences of this kind of a phenomenon, because in the beginning, most of it, you're not really paying off much of the principal towards the beginning of the cycle, right? You are mostly paying interest. Towards the end, you're mostly paying off the principal. Now, in this country, because it's not a bad thing, because the interest itself, especially for mortgage loans, the interest is tax deductible, which means even though you're paying a lot of interest on the loan initially, and very little of it is going towards paying off your principal, in practice, you're actually getting a benefit because of the tax break that you're getting. But not a whole lot of equity is being generated. You're not really building up equity on your property in the beginning. Okay, that's the downside. Towards the end of the loan cycle, you are building up equity at a much faster clip on the property, and you're getting relatively less in tax benefits. So it's a kind of a trade-off that you need to be aware of. But so when we solve problems of loan amortization, these are the principles that we will be using to solve them, as we'll see with the concrete example.